Good afternoon and welcome to BizTech's Asian Midday Market Watch. On today's show, we take a deep dive on how the Fed did not show any inclination to pivot from its hawkish policy last week. Now, to give us insights, we've got our guest today, Lee Kian Soon, CEO of Astral Asset Management out of Singapore. Kian Soon, great to have you on the show.
Good afternoon.
Now, Kian Soon, before we get your insights on the Fed policy and why they did what they did, let's first take a look at crypto markets, and then we'll take a look at how regional stock markets have performed in the first half of the day. So we've got Bitcoin, which is at 20,177. It's up 0.63%. Ethereum is at 1,594.64. It's up 2.69%. Now, looking across the regional stock markets, we've got the SGX, which is down 0.41%. KLCI is down 0.03%. Shanghai is up 0.18%. The ASX All Ordinaries is down 0.13%. The Nikkei is pretty flat. It's just down 0.01%. The Hang Seng is down 0.68%. And rounding up the numbers, we've got the Kospi, which is up 0.32%. Now, Kian Soon, what are your thoughts on the market performance in the first half of the day?
I think we have a mixed handover from last evening's the US markets, and Kospi, no surprise, is positive and up, mainly because the inflation numbers are showing some improvements, and the market is taking it in their stride that the inflation could be under control because of their rapid interest rate hikes.
Now, Kian Soon, again, we want to talk about why the Fed did not show any inclination to pivot from its hawkish policy, despite pressures from different corners. Perhaps you can start by giving us some historical precedents as to what has been guiding their action.
I think history has served as a good reminder, for Fed and other central bankers that if they are too quick to step on the brakes of rising interest rates, they could, repeat the missteps of 1970s. And that has resulted in a decade-long of high inflation numbers and double-digit interest rate as high as 20%. So when your interest rate as high as 20%, the real estate and the auto industries and all the industries who are dependent on loans are very badly hit. And so inflation is a very challenging beast to tame, as history has shown. And the longer this drags, the harder it is to manage.
Now, of course, also tempering their action is the fact that the current US economic indicators are all still looking good. Its consumer numbers are good, employment figures are good, and also corporate earnings are still very strong.
I think that's correct. I think if you look at the figures, economic indicators and figures that has been released, especially there will be the employment numbers that's going to be released tonight, all barometers are showing that the numbers are good. And there's ample room for Fed to, take more action, and corporate earnings are strong as well. And therefore, the worry that, you were going to experience an immediate economic decline or recession is less.
But Kian Soon, then what should we be expecting for the rest of 2022 and 2023?
I think, we can all expect that, after Powell has set the right level of expectation this time, interest rate is going to continue rising, and until the inflation figures are under control and within the target that they try to achieve, which is 2%, and we are still far away from that. And unfortunately, the implications for such policies are that the US markets are going to be underperforming and bleak, because rising interest rates and followed by a declining economy ultimately because of the rising interest rate is never great for the markets.
Yeah, and that's true. But the thing is, one of the things in the back of investors' minds, which is of course going to impact corporate earnings, or the fear that it will impact corporate earnings, is the fact that there are dire predictions of a very hard landing in the US. What are your thoughts on that, and how is that going to impact earnings?
I think so far the figures, economic figures have showed that, there's not going to be a hard landing, but with the Fed policies, these are macro policies, and seldom would you be able to manipulate or adjust until you get that fine landing that most investors would like to look out for. It's very likely that the interest rate rise and the continuous interest rate rise in the coming months could result in a hard landing. But I think the key thing is, if there's going to be a recession, the key question to ask is it going to be very long, which I think is very unlikely. Rather, you could have a short recession and get over and done with. And the best case scenario is thereafter, inflation is under control, then things will be easier for everybody.
Okay, so in that sort of scenario, so investors, given the fact that we as investors shouldn't fight the tide of central banks, what should we be doing from an investment standpoint? How should we position ourselves?
I think in terms of positioning, if you are looking at fixed income, you need to understand that the rising rate environment means you have to switch to shorter duration fixed income products, right? And avoid the long duration ones, simply because there is an inverse relationship between interest rates and prices of fixed income products. For equities, I think the era of growth stocks is over, because as interest rate rise, and value stocks will be back in full swing, right? And it's always good to look out for stocks that perform well in an inflationary environment, in particularly, companies that could transfer rising costs to the customers easily versus companies that couldn't do that. In terms of currencies, I think USD will be back in favor. I think we just have a parity between US dollar and euro. I won't be surprised at this current state we could see parity between US dollars and sterling pounds as well. And this is a result of, the delays between the different central banks, right? You could see that the Japanese yen is affected. And, a lot of the emerging markets currencies will be affected as, the Fed runs ahead of the rest of the central banks. And last but not least, I think diversify. Always have a good mix of asset classes in your overall portfolio. And diversification will ensure that you have a more steady investment return over time.
Yeah, Kian Soon, thanks for that sagely advice, and thanks for coming on the show.
You're most welcome.
Now, we've been speaking to Lee Kian Soon, CEO of Astral Asset Management out of Singapore, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks for tuning in.